We're doing a quick strike today. No time for clever questions that I usually ask. Maybe on the back end. Welcome to the Casual Friday Financial Insights podcast. We're going to have to change the name again because I get it wrong weekly, I'd say, right? My name's Brian Ullman. I'm a financial advisor with Ford Financial Group. I'm joined by Ryan Louie and Eric Simonian's financial advisors, CFP. All of us are CFPs here at Ford Financial Group, reacting to today's Federal Reserve announcement with what they are doing with Fed fund rates. Ryan, do you want to take this one? Let us know what happened with the Fed.
Yeah, and maybe we'll go back a little bit over a week. Everyone has, at least in the finance world, has been waiting for this moment, which is an interest rate cut. And we were all debating whether it was going to be a 0.25% cut or a 0.5% cut. Right. That was pretty much the two numbers we were debating about. It wasn't whether they were not going to do it, because that wasn't really in the cards. But last week, about this time, there was about an 85% chance it was only going to be a quarter rate cut. It was last Friday.
Let me interrupt. Yeah. What were your predictions before today on what the Fed was going to do?
Okay, I get to say this because we're on the podcast, and there's record of it on the previous podcast. I believe it was in June or early July.
Okay,
I was talking about how I was listening to someone, and he argued for the fact that there should be a July quarter point cut, but because July was so close, and that what was likely to happen was there was going to be a 0.5% cut in September. Wow. And so that was not definitely the odds being in my favor with that comment that I made back in July.
Okay,
called it early.
So you called 50 basis points. I think I remember that. Eric, what was your call before today?
I think we both called 25, if I recall. Brian?
25 was mine. I know that. Yeah, and I was telling everybody. In fact, I did an interview with DeYoung Properties, who had a live stream earlier today talking about mortgage rates, and I called 25 basis points before that. So, if you're going to be wrong, be loud wrong, right?
like hours before the actual cut.
Yeah, hours, days. There's no bounds of where I can be wrong, I guess. So, Fed cut rates 0.5%. And markets were reacting. I would say markets were flat essentially for much of the day. And there's been kind of, we're looking here on CNBC, markets popped on the reaction, but then kind of pulled back a little bit. What do you think markets are reacting to right now? It was a bit of a
I think this was exactly what was expected. If you look at the rally and you look at the probability of the rate change, it's pretty much, it flopped from 25 to 50, the recent rally. So I think today was expected and was kind of priced in. So I don't think it's enough to really spark.
Yeah, maybe to add on to what Eric was saying, if you looked at the 5-day chart and going back to like what I was just saying, the odds were going from 85% a week ago of just a 25% hike to 50% Friday to this morning. It was like 40%. I think that as the odds probably got higher, the market was already rallying. So it wasn't so much about today as the odds just got higher and higher towards a 50% or 50 basis cut. The market was already moving the last 5 days.
Sure. Well, and you can see what we're looking at right now. I know it says Dow Jones in the top left, but this is actually 5 kind of indices, if you want to call it that. So the orange line is a Dow, purple is NASDAQ, small caps, so the Russell, you can see was particularly volatile today. S&P 500 in blue, everything down. In green were bonds, which were negative most of the day, but broke positive briefly while giving that back up. I'm a little bit surprised that the market was down. Does that just tell us that everything was kind of priced in?
I also think the market was really, really indecisive, as you can see from these charts. I mean, the Dow was swinging 300 points every like half an hour, up and down. As you can see by the charts, it would swing one way, then go back the other, swing one way, go back the other. Obviously, ending down for the day, but yeah, I feel like a lot of indecisiveness from the market after the news.
Yeah,
I mean, it's the excitement, right? You get the cut, everyone's excited, and you look and it's, well, to your point before, Ryan, that's kind of what's been building up for the last 5 days.
Yeah, I mean, it popped on the headline, and then but you always have to wait for Powell's conference press conference afterwards to get an idea. We watched the press conference. I thought he was fairly dovish, right? He was saying, yes, more cuts he's never committal, right? But more cuts may be warranted. We'll take in the data, I don't know. I thought there was a lot to like if you were looking for rates to be cut further in November.
The dot plot was for what? Two more cuts or 50 more basis points by the end of the year.
Yes. Yeah. In fact, let me pull up the dot plot here. Oh no, I thought I had it. I don't. Well, am I able to share this? Are you guys able to see the dot plot there?
Yes, it's real small, but
okay. Yeah, it's hard. Let's see if I can blow it up a little bit here.
I mean, we will summarize anyways, because without giving an explanation of what all this means, it's probably just easier to say what is expected going into the future.
Sure. Well, and I think we're reacting so quickly. It's hard we don't have our normal charts ready yet, but there's an expectation that rates are going to continue to fall, and some of the votes were that by the end of the year we're going to be just above 4%, which is still quite a bit of cutting going on between now and the end of the year.
I think if you saw the average around 4, that would have probably had a little more action on the upside.
No doubt. But there was some recognition in the Fed statement also that. There were, I'll share it here again, probably a little bit too small to see, but just this recognition that inflation is moved what they think is sustainably towards 2%. Some recognition that they need to support maximum employment and not just look at the inflation or price stability objectives. I mean, if you were really worried about the Federal Reserve ignoring the rising rates of unemployment, they're not. They're seemingly not.
No, they're trying to balance this.
That they specifically targeted unemployment and kind of backburnered inflation.
Yep,
so it's definitely a pivot.
Maybe this is the SOM rule at play, which was designed to actually help the central bank know when they need to start to loosen things up. We'll see. Now, the question, I think it's interesting because, okay, there's all this 0.25%, 0.5% rate cut by the Federal Reserve, and everybody's taking bets and making bets and having opinions, some right, some wrong. But that's not what really matters here, right? Because what we're doing is embarking on a series of rate cuts that are coming, which kind of takes us to what's going to happen next in November. I don't want to put anybody on the spot, so I'll just share. This is the CME Group FedWatch, projecting the likelihood of cuts in the next meeting on November 7th, which is not quite 2 months away. The odds are okay that they're going to may stay the same, but they're pretty well pricing in a rate cut for November 7th. The question again is just how much, by a lot or a little. This is saying there's a 70% chance that it's going to be a 0.25% rate cut. Do you think that kind of jives with your thinking?
I think that anything larger probably would start alarming people to the economy if they do a half and then a half right now, because it might be a little bit too much too early.
They're behind the curve, right?
Yeah, I mean, I guess that if it's a half, if they're cutting a full percent in 2 meetings, that suggests they are behind a little bit. And we'll have 2 jobs reports before the next meeting, right? We'll have the September report in October and the October report in November. If unemployment keeps creeping higher, then maybe that is what could spur them.
The October report, I think, comes out like the day of the Fed meeting. I could be wrong on that.
Oh, yeah. That would make sense, or the day before the Fed, or
pretty close, right?
7th.
During their blackout period,
right? Yep.
So that can always be lead to a surprise.
It could. It really could. So I guess that leaves us with nobody knows for sure. Other than that, as we go out, We'll have some more of these charts that we're able to digest and peer a little bit further in the future as to what the odds are and futures markets are. But rates are being cut. So is this helping or hurting stocks? What do you guys think?
I don't think it helps them, but I don't think it hurts them right now because, like as we were talking about, I think that's priced in. So spark a rally.
I think we always have to talk about things being priced in because that always definitely tends to make sense. I think for the economy, it definitively helps the economy. Whether the stock market's priced that in already, that is the question. Sure. But you're talking about mortgage rates. We're at 2-year lows on the 30-year. It's at 6.19. I'd say if you get mortgage rates maybe down another 0.5%, I think you're going to get a lot of people coming off the sidelines looking at housing again because you're in the mid 5s now.
Sure.
So that's such a huge industry that really will help help the economy because it's been sidelined for so long the last couple of years.
Is that enough to get people to sell out of their 2.5% mortgages?
Yeah, I think it gets people to buy it too. The first-time buyers too that couldn't afford when it was at 8. They're gonna look at it. So I think that a lot of money moves in the real estate market. Anything that has a loan is going to be affected. Again, cars might start selling a little bit more as rates come down as well.
You could even have small businesses borrowing, right?
For sure.
To fund expansions. I mean, that's what that's what happens when money is cheaper to borrow and buy, you get some stimulus. I think the real question we've got to look at over the next 12 months is whether or not the Fed, and we won't know this now, and we probably not by the end of the year, but whether they are too late. Whether the unemployment, whether the trains left the station, so to speak, on economic slowdown, that could fire us into even if it's a brief and shallow recession. We've talked a lot about leading economic indicators have been negative for a long time. The yield curve was uninverted and then was inverted and then has uninverted, which is usually a sign that a recession is close. Unemployment crossing over in the Somme rule, also a recession indicator, right? So there's a whole ton of recession indicators. Are they early enough? Are they moving fast enough to make those things, to make it so this time it's different?
Like what's the lag, right? They're always saying their policies in there's a lag.
Yep.
And how long is it?
So what do you think, Eric? Are they on time? Are they late?
I think they're probably late, but by how much? I mean, they're always late, or they're never early, I feel like.
That's right. I totally agree.
Well, this is maybe one of the rare times though, if we hit a recession, I mean, how often do you hit a recession and before the recession has been called? Because again, you're looking 6 months in the rearview mirror when you're calling a recession, but they're already lowering interest rates and we haven't had a recession. That's not a normal circumstance to have happen either.
Nope.
Maybe it's different this time, right?
It could be.
It's going to be different this time. It's just maybe how, right? I mean, it may be different this time. And let's look at the optimistic side. Maybe they got their soft landing and like the Fed did a good job and they weren't behind it. I mean, that would be kind of unprecedented in a way as well.
Yeah, it would be and I think unprecedented because like it's so rare. It's so unlikely. That I think everybody can kind of agree that one of the reasons they're doing this is because they're recognizing there's some economic slowdown here.
Yeah, 100%.
And so the question is the slowdown so much that we are facing a recession, or is it just slow growth, or even no growth, but just flat?
The way it looks right now is it doesn't look bad.
No, it is not bad today. It is not bad today. And I won't be able to find the chart here, but there was one, I think it was on the Daily Shot today, that the Fed is actually below. Oh, here we go. I'm going to see if I can share this with you. I can't really blow this up, but what this is showing is that the unemployment rate is actually on the low side historically for when the Federal Reserve cuts. And so usually unemployment has risen more than where they are. So maybe this suggests perhaps that we're a little bit, or that the Fed is earlier than usual. I don't know. Earlier than usual, maybe. I don't know.
The employment numbers, they paint a rosier picture than what we've seen in the past.
Yeah, well, it's certainly our unemployment rate's better, the job growth is better, but the trend is not good, right? The trend is slowing. And so if you look at the numbers in the abstract, sure, 4.2% unemployment is below the 6% average since 1960, but it's gone up 1% almost over the last year. And it's trend versus the raw number. I think that's the problem here. I
could be wrong. Didn't they predict 4.4 at the end of the year? Was that?
Yeah, I think so. Or I think it was maybe 4.4 or 4.5 at the end of next year. But it's mid 4 projections for the last couple of years. That is what those Fed projections were today. So I feel like they're stopping. They are thinking that they've stopped this rise in unemployment in its tracks.
It's gonna plateau soon.
Soon, yeah. I don't know. Ryan, you're laughing. Is that just preposterous?
I don't know. Trying to control it, and like in a short amount of time too, with interest rates is not an easy thing to do. So no. it's just one of the data points that they're looking at.
Yeah. Well, I mean, they're still reducing the money supply, and raising and lowering interest rates, I would describe as a blunt instrument that they're trying to use surgically. And it doesn't seem like that works when you try and do those kinds of things.
It paints a background, but not the details.
That's right. We'll see. I've already been wrong once today, so maybe I'm wrong twice, and we don't find ourselves in a recession at some point in the next 12 months. But my bet is that they continue to cut, and we do get that full % rate cut this year, and one of the reasons they're cutting so aggressively is because the economy is continuing to slow. That's my bet here. We'll see. You guys think I'm far off?
No, I like your prediction. I think I'd probably go pretty close to that. I think as much as I said in that other podcast about the interest rates and got that right, I do think that there was another podcast I did say that we were talking maybe about manufacturing numbers or something. And I did say that I do think we'll see a recession. So yeah. I guess I better stick with that instead of, flip-flopping back and forth.
Well, it just makes me nervous when we say this time it's different. Now, COVID and its aftermath, I mean, that's like once in a lifetime kind of stuff. But is it ever really different? I just
it doesn't repeat itself, but it rhymes, right?
That's right. I think that quote's from Mark Twain or something. But yeah, it's we're still in the same place this afternoon than we were this morning, like economically, right?
Sure.
There's some help on the way, but we're not going to all wake up tomorrow and have the 10-year Treasury be all that much different just because the Fed cut rates today. Because like you were saying, Ryan, it's all priced in pretty well at this point. So, are you guys sick of talking about Fed fund rates and interest rates and projecting those things?
I'm so glad it happened today because I feel like we've been talking about it for a year.
Yeah, I think the pivot is more important than anything, and so now probably not so much of a subject of it because we've been waiting for this forever. And earlier this year, it seemed like they weren't going to do it, right? Like after we expected it in November, December, we got into this year, it looked like it wasn't going to happen. Yeah. So yeah, I'm tired of not knowing, and now it feels like there's more definitive a path. We know it's going down. How much we don't know, but it's going to go down.
Some history here: we haven't had a rate cut in 4 years. The last Fed rate increase we had was more than a year ago. So you're right. The pivot is newsmaking. I have a hunch, though, at the end of October, we're all going to be having these same discussions as the next Fed meeting is around the corner, just because it's so influential.
That's possible.
Yeah. Well,
maybe likely.
I think we're happy the day has passed. I think the news has been good largely. You can't tell me that 0.5% Fed fund rate cut when you're not in a recession isn't good news. But I think we'll see in time how good of news this is. And we'll be talking about this more on the podcast. We wanted to kind of react quickly so everybody could hear our thoughts. If you have questions about interest rates, you can email us at info@fordfg.com. If you want to hear more of these episodes as we continue to talk about this, as we digest what the Federal Reserve has done and what the effects are slowly kind of becoming in the economically and in markets, subscribe to the podcast. You can watch us on YouTube. You can listen to us on Apple Podcasts, Spotify, or wherever else you listen to podcasts. Okay, so let's just go on the record one more time. The November cut will be what, Eric?
25.
25, Ryan?
25 and 25, meaning
25.
November, December.
25 November, 25 December. Is that what you're saying?
Yep.
Yep. I think 0.25% November. But we have a lot of data between now and then. So let's do this again before November 7th. All right.
Sounds good. Thank you.
Thanks, guys, for jumping on.